Hello again, good morning once more, and welcome to New Day on TV3. Okay, so the debate about interest rates has raged on for several months, and the current Minister of Trade and Industry, Dr. Ekos Gabra, has also waded into it and saying that generally interest rates in Ghana is relatively on the high side. But that debate from some quarters has gone in favor of it being on the low side, and that Ghana needs to position itself well if it has to do businesses, and also factor in how businesses will survive and do well going forward. I have three gentlemen here to help me put the issue in perspective. And then also, there is an upcoming conference, and we have a representative from the Trades Ministry to tell us about it and what we should expect at the end of that conference. Let me introduce my gentlemen here. From the extreme right, we have Nasir Ahmad Yate. He's the Deputy Communications and Public Relations Officer for the Ministry of Trade and Industry. And then also in the middle, we have Dr. Eric Osei Esibe. He is a Senior Lecturer of Economics at the Economics Department, University of Ghana, Legon. And then also Seth Chum Akwaba. He's the Chief Executive of the Ghana Association of Ghana Industries, AGI. Good morning, gentlemen.
Good morning.
All right, I'm sure every now and then the issue of interest rates come up, and you've all engaged in that debate. Starting with you, Mr. Akwaba, how serious is this, especially with businesses? Are you on the side of the fact that interest rates are on the high, and what kind of impact is it having on businesses?
Well, thank you. Indeed, interest rates is a major cost component to businesses, and for businesses you want to operate efficiently, reduce cost to the barest minimum so you can compete within even your own country. In Ghana, you see a lot of imports come in to compete with us, and what you want to be able to do is to reduce your cost of production. Right. And for industry, interest rate is a major challenge. It's a major challenge in the sense that you're borrowing at, say, 30%. What business would you do to make that kind of margin that will enable you to pay this cost? It's a major cost component. And the worst part of it is that for the SMEs, it's even worse. Because when they're calculating the interest rate, one major factor they take into account is the risk level. Right. For SMEs, their risk level is considered high. The potential for default is considered high. And that risk factor even makes it worse. If you take the typical small enterprises, the micro enterprises, for example, they borrow more from the microfinance institutions, savings and loans, and there it's even worse. You're talking of 6% per month, and when you accumulate it for the end of the year, you're talking of over 72%. What kind of business will you do to make that kind of money? And the effect is what we are feeling. The effect is that people are not able to borrow medium to long term. You can only borrow short term because the interest rate is that high. Then you can't do business that is long-term in nature. And for that reason, the people who are able to borrow more are the traders. So you go, you buy, you sell. Within 3 months, you pay back. That is the only way you can manage it. So for even big businesses, they probably only borrow for their working capital. But for reinvestment, if you want to buy machines, if you want to expand your factory, or if you want to put up whole building, it is almost impossible to borrow at 30% and make any serious money out of it.
And normally those ones are from the middle to long-term investments, kind of, by, when you want to acquire machinery, putting up structures like that.
Exactly. So you're talking of medium to long-term, and I mean 3, 4, 5, 6 years, even sometimes 10 years. And unfortunately, that's the kind of facilities companies elsewhere in other countries who are competing with us are getting. So if they have the access to those facilities at relatively much lower interest rates, long-term, good enough grace period and all that, they are always at a better competitive edge over you. And that's the reason why we are not being competitive in our manufacturing sector, and so much goods is coming to the system to compete with our companies.
Let me bring you in, Doc. What are some of the determinants of an interest rate? What goes into saying that they are pegging the interest rate at this percentage?
Well, thank you. There are various factors that determine the level of interest rates. But first of all, we can pin it down to what I would say systemic risk, and then the idiosyncratic risk. If I should break that down, the systemic risk depends on the high macroeconomic uncertainties, and then the weakness in the contractual and the information environment that we have. Now, the macroeconomic environment usually will be on the level of inflation, the level of treasury bill rates, the level of other key components like growth and others will determine the level that it will be, first of all, be pegged, particularly the government-owned borrowing levels, that is the treasury bill rates, will then form as the base for any bank. Then the next thing will be the level of risk, that the systemic risk, the expectations of inflation. Okay, what we expect inflation to be, because banks always look at the expected returns from the loan that they give, and the expected returns depends so much on the interest, and that interest is the real interest, not the nominal interest that you see. The real interest is the nominal interest minus the inflation rate, and therefore if the inflation rate is going up, the nominal interest must also go up, so that at least the real interest rate will be constant. That is the basic theory. And so if the inflation levels are going up, then we expect the nominal interest rate to go up. And so also if it's coming down, we expect the nominal interest rate to come down. And then the next one, which is the idiosyncratic risk, is the individual, that's the economic agent, the risk associated with you. That is what Akoba referred to, that if you are SME, your risk level is high. And therefore, the bank will calculate what we call the risk premium. They will add some premium to the loan that they are charging, so that that will cater for or compensate for any default risk probability or whatever. If you are not able to pay, then they use that. So that will determine how much you have to pay. So these two will combine to determine the level of interest rate at every given time. So if the basic rate, that is the rate at which government is borrowing, is a key factor, the systemic risk in the environment, the extent to which the bank can enforce contracts and repayment, the contractual and the environmental environment regulations, the credit bureaus, the law courts, and others that they can always enforce to ensure that the loan paid is gotten back. Even the address systems, so people can be traced, and all that are part of the risk build-up. Okay, and then the individual, whether you're the level of risk, you're credit worthy, or your level of risk, that is the idiosyncratic risk, which depends on what we call the agency problems, the adverse selection, and the moral hazards. Which is in such an environment is very high, and therefore banks are mindful of who they give out loans to because of these problems. So at every given time, this determines. But in all of this,
and the consideration level, which key institutions are supposed to be the final deciders of what an interest rate should be? And do we factor in businesses and people who are, by extension, supposed to be the beneficiaries of loans, and by that, talking also about the interest?
Well, ideally, it depends on the kind of regime that you have. If you have a controlled regime in the past, as we have, then the central bank controls the interest rate that is charged. That is controlled, regulated environment. But now we have a deregulated environment where the level of interest is purely determined on the market basis, the demand and supply of loanable funds. That determines the level of interest rate. And therefore, we do not actually have a particular key institution that...
But we, as you rightly said, we want to tread cautiously and make sure that we also want to be very measured in our expectation. We just want to start the debate and then see what kind of recommendation we can come up with, and then as the years go by, we see how we can work with the recommendation to get interest rate down.
Okay, let me bring in Seth here. First of all, your take on the conference, and then also, do you necessarily want to state that you need a lowered interest rate, and how much would you say is generalized and is okay for businesses?
Well, as far as the conference is concerned, we are very much part of it. We are supporting the ministry to do this because AGR has over the years expressed so much concern about the high level of interest rates. If you look at our business barometer report we've been coming out with, high cost of credit and access to finance as a challenge constitutes one of the highest scores all the time. And if you track it, almost every quarter when we do this, it features prominently. So it's an issue that we are concerned over, and that's why we are supporting the ministry to do this. But I agree with him that we have to have a measured expectation. We are not expecting that overnight things will change. But let me come to an issue that you asked, Doc, concerning the regulation of the interest rate. Yes, we are not in a controlled regime. We don't have a finger somewhere that is controlling how much interest rate in the banks constitutes a lot. I mean, contributes to the level of interest rate so much.
Okay.
So much as you are not controlling, you are not fixing it, your actions are contributing. For example, if government is borrowing at the rate of 25%, which is the treasury bill rate, no bank, and that's a risk-free arrangement. So no bank will borrow, will lend below that. Definitely, it must be treasury bill rate plus something. Today, even the policy rate, which is Bank of Ghana's own level, below which banks will not go, it's 21%. So what do you expect? So those actions has serious effect on the level of interest rates. Even though you are not fixing it, you are virtually telling everybody that don't go below this, and that's exactly what is happening. So if you want to deal with it, I think that of course the banks are the ones we work with. They are the ones we borrow from. But in actual fact, government also has a major role to play in making sure that we have interest rate at reasonable levels. So what it means is that we should have macroeconomic stability such that government wouldn't need to borrow so much and crowd out the private sector from the borrowing, because we can't compete with government.
Right.
So for me that is also very important. But on the banks also, they also have another major role to play.
They certainly also have some position on this.
Yeah.
But Doc, really, what can government do? What can government do in this whole debate? Can government just, yes, in consultation, force a fixed rate? And then how empowered is government to help in this entire decision making?
Well, I started off by saying that the level or the high level of macroeconomic uncertainty is a key factor in exchange rate determinants in every country. And therefore, government has a big role to play. I agree with Seth. The whole idea of the setting of interest rate, although it's not a mechanical thing that anybody can set, but it depends largely on the kind of macroeconomic environment that you are in.
Okay.
If your macroeconomic environment is stable, if you are recording single-digit inflation, it's expected that inflation or interest rate will come down. And therefore, it starts off from the government. If government is able to stabilize the economy, if the inflation level begins to go down, and the government owns fiscal deficit, which is a key driver of macroeconomic uncertainty or certainty, if that is also managed and then complemented by a very effective monetary policy from the central bank, that even in the past, where we have seen that inflation levels have come down and interest rate, inflation is single digit, and even government-owned policy rate is about 11%. Lending rate has remained so high, about 25%. Now the issue has been what is really keeping the interest rates that high. So what government can do it by, which is very important aspect, but it also behoves on the banking system to be much more efficient in their operations, because if one of the key determinant of efficiency is the level of interest rate that we charge, and then competition. Sometimes we wonder whether indeed there's competition within the banking system. Because if there's competition in the banking system, one of the key trigger is that price has to begin to fall. And price here is the interest rate.
Right.
It has to fall to show that indeed banks are competing among themselves. So that has to also be there, that the banks themselves must also ensure that they operate much more efficiently. Because the argument has been that the operation cost is high. And once the operation cost is high, they have to translate that into the loan build-up, and also the risk that the non-performing loan is high, which also increases their risk. But if they operate much more efficiently and they close the gap between the saving rate and then the lending rate, one, they are going to be able to mobilize more savings because savings become more attractive. And that will reduce the cost of money for them, the banks. Because if they are able to mobilize more savings by offering attractive interest on savings, they will reduce significantly the cost of borrowing from other sources. And that can be translated into the lending rate. And that will reduce the spread between the lending rate and the saving rate. And you see that in an efficient financial system, you see that there's a very limited gap between the saving rate and then the lending rate. But here, if the saving rate is 4%, lending rate is about 30%. That is shouldn't be the case. That's too wide. It's a sign of inefficiency, within the system, and that has to be addressed. So we have to look at it from both sides. From the side of government, which I believe that it should be, it should drive this the way, and then there's also the banking own system. Sometimes we want to believe that there's some kind of tacit collusion within the banking system, because how come we have too many banks, but they don't seem to compete among themselves?
I was actually about coming to that question to ask whether there's a possibility of having a regulation to bar some of the banks, or any bank for that matter, to go beyond a certain level, because they can probably want to step 2-3 times lower than the agreed one, where you are going to now have, so they can attract all the people who are coming to their side to borrow. Yeah. Could there be that kind of regulation? Or is there that kind of regulation?
No, there's no that regulation, but it should be
gone. And then also Nasser Ahmed Yate, Deputy Communications and Public Affairs Director of the Ministry of Trade and Industry. My name is Martin Asidu Dati.